The broadcast is now starting. All attendees are in listen-only mode.
Good evening. Good evening, everyone, and welcome to the first quarterly Market Insights webinar of 2020. We sincerely thank you all for joining us. As always, I'm excited to present our speaker for tonight, Sean Kennefic-Rogers. Sean is one of the founders of Ironwood and serves as the Chief Investment Officer and is a holder of the Chartered Financial Analyst designation. We welcome questions, but ask that you please type them into the GoToMeeting message box, and we will field them all at the end. Without further ado, Sean, the floor is yours.
Thanks, Jared. And thanks everyone for joining our call this afternoon/evening, depending on where you reside in the country. Wanted to start off the presentation today by going over the 2019 environment, returns, kind of just doing a recap of 2019, where that puts us in the current cycle, kind of give you our thoughts going forward, and what things we're keeping an eye out on, and what issues we're looking at, and trying to see how what info will shape our decision-making process here over the next 12 to 18 months. So with that, I'll go ahead and jump in. So 2019 was really the year that we basically we told ourselves we were going to avoid recession, and that's a lot of the year was based on that. If you'll put yourself back in the fourth quarter of 2018, you'll remember that the S&P 500 dropped just under 20%. I believe it was 19.8%. Small caps dropped over 20%. International emerging markets dropped over 20%. So a lot of aggressive assets actually had what are called what is a definition of a bear market, or dropping 20+%. And then in 2019, we avoided those recessions. We did not have a recession in the United States. We did not really have a global recession, and stock markets repriced accordingly. We did invert on the yield curve, and the yield curve that I'm talking about is the 2-year versus the 10-year Treasury for 3 days in August. So that was something that we were concerned with. However, with it being 3 days, and then with the next bullet point, the Fed cutting 3 times, and interest rates across the curve dropping from their 2018 highs somewhere between 1.25% to 1.5%, the yield spread actually increased back to about 19 basis points to where it is now. So we're less worried about the inverted yield curve. 2019 was full of tariffs, trade skirmishes, and then ultimately some trade deals that got done here recently. So we'll kind of go through some of this, but first I wanted to just start with the returns. Once again, large cap US did very well, 31.5% return. REITs were up 28.7%. That's real estate investment trusts. Small cap US was up just over 25%. Developed international was up 22.7%. Emerging markets were up 19%, 18.9%. Even fixed income had a great year last year. Your Barclays global, your Barclays US aggregate was up almost 9%. Commodities were up 7.7%, and cash was up 2.2%. So across the board, aggressive assets did very well. Safe assets did pretty good too. Like I mentioned before, a big part of this was really the fact that the markets had priced in a recession at the end of 2018. And I thought this slide was a really good reminder of that. You can see this slide breaks down the return in 2018 into the blue box here, which is the return that was from earnings. So we had a very positive earnings story in 2018, mostly because of the tax cuts. Then we've got dividends, call it 2% in dividends. And then we've got this big gray negative box that brings us all the way to a negative 4.5% total return for the US in 2018. This big gray is multiples. And that just means that our multiple went from, call it 19 at the beginning of 2018 to about 14 right Christmas Eve 2019, or I'm sorry, 2018. Multiples are what an investor will pay for an earnings stream. So investors were not willing to pay because they were expecting a recession and they were expecting earnings to drop. And that's why the multiple contraction happened in 2018. You can see it wasn't just the US, it was across the board. Big gray boxes represent multiple contraction. Well, flip into the end of 2018 after Christmas, we had a rally going into the new year, and you can see in 2019 it was exactly opposite. We actually had some earnings deceleration outside the United States. Earnings definitely slowed down in 2019 inside the United States, but we still had 31.5% returns in the United States and pretty high elsewhere around the world as well. That was just a repricing from, okay, we're going to go into a recession and earnings are going to come down markedly, to we avoided a recession and we're no longer going to discount earnings and we're going to pay up for earnings. And so that's really, if you want to look at 2018 and 2019 in a nutshell, that's what really happened. Now, if we look at previous periods of time where we've had bear markets, and I'd say 19.8% drop on the S&P, and small caps over 20%, and international over 20%, and emerging markets over 20%. I'd say for the most part, that's not technically a bear market, but it's pretty dang close. And one of the charts that I found very interesting from one of the presentations that we saw from Jim Paulson is, when a bear market does occur, if we look at what the subsequent bull market looks like and we overlay that with what we have had this first year, you can see that it doesn't exactly rhyme. It doesn't exactly follow it, but it does rhyme. Excuse me, it doesn't exactly follow it, but it does rhyme. It's very close. And if we were to follow the same trend here, that would portend about another 10% upside on the S&P 500. Now, if we're to look at this over a longer period of time, this is something that Ironwood has talked about. We've talked about not quite in this manner. I thought this really exposes the pattern here. But we've talked about these 10-year consolidation periods followed by 20 years of boom. And during that same Jim Paulson presentation, we saw, or he overlaid the super cycles, is what he calls them, which are 10 years of revaluation where you have a consolidation, the market doesn't really move anywhere, and then 20 years where the market has very, very good positive returns. And if we were to look at the last 3 super cycles, including the cycle that we're currently in, it looks very similar, where we've got 10 years of consolidation followed by 20 years of very good positive equity markets. Now, you still have intra period drops in the markets, so those should be anticipated. It's not going to be a straight line up, and we may not follow this exactly, but so far we're 20 years into this cycle, this 30-year cycle, and it's following pretty closely. Now here's the slide that I usually show during this, and I say, okay, post-war era, We've got 10 years of consolidation, followed by 20 years of expansion, 10 years of consolidation, 20 years of expansion, 10 years consolidation, 10 years so far of expansion. How far this goes, that's the $1 million question. It's very difficult to know how far that can go, but we just need to know that it doesn't, just because this expansion is 10 years old and we've had very good market returns over the last 10 years, it doesn't mean that it has to end. So we just want to make sure that on the upside that we're not missing out and becoming too conservative too soon. Now, with that said, we also want to be prudent and we want to look at valuations and we want to look at where we are. And there are some concerning things out there. One of which is the concentration in the S&P 500. The current concentration of the top 10 companies, which we've got the little logos here, if we add all of these up, we're at 28% of the S&P 500 market cap is in 10 names. So that means that the other 490 stocks that are in the S&P 500 only make up 72%. So we're getting very concentrated. Just to put this into perspective, at the beginning of 2000, the top 10 S&P companies constituted 22% of the market cap. Just as of note, value went on to outperform growth over the next 10 years in that period. If we want to look at a different way of looking at this and look at the top 5 companies, so this is where we were about a year and a half ago. We are now all the way up here at 20. It was 20.1%. The top 5 companies are 20.1% of the S&P 500. That's more concentrated than March 2001. So definitely something that is an issue that is a bit concerning. However, if we look a little bit deeper and we look at valuations compared to March 2000, you can see that we're still not quite that expensive. So there still could be some upside, but at these levels, the large cap U.S. stocks, if you just look at the S&P 500 market weighted, we're not undervalued. We are overvalued or slightly above fair value. With interest rates as low as they are, you could make an argument that multiples should be expanded, or you could argue that we could have higher multiples, but we also want to be prudent, and we've been reducing our large cap U.S. exposure over the past couple of years, and we will be doing that here a little bit when we make our next rebalance, which I'll talk about here in a bit. So we want to be prudent. We don't want to get too aggressive. When I was preparing for this webinar, I actually looked back at the guide to the markets that JP Morgan put out at the end of 2008. I was actually looking for a piece of information that I wanted to bring up in this slide, in this presentation, but it got me looking back at 2008, and you put yourself back in 2008 and you see all the charts and you see the down 40% and you see where interest rates went and you see where commodities went, and that can happen again. And so we want to make sure that we're just staying balanced in our portfolio. And S&P 500, as of January 31st, the PE multiple was 18, just slightly over 18. After the past week, where the market's up, about 800 Dow points, the S&P 500 PE multiple has gone up almost an entire point. It's at about 18.9, 18.8, 18.9, depending on what what you're looking at, what earnings estimates you're looking at, but call it 18.9. So it's almost gone up an entire point in about a week and a half, more like a week. So we just want to be careful. We're definitely not undervalued anymore. And you can see that 5 of these 6 metrics are telling us that we're either fairly valued or slightly overvalued, maybe even extremely overvalued, depending on your take on it. I would tend to say maybe just a little overvalued with where interest rates are. And then if you look at stocks versus bonds, you're still wanting the valuations are still pointing to stocks being more attractive than fixed income, and that makes a lot of sense when the 10-year Treasury is at 1.65%. So just want to keep those things in mind. Why do I focus on PE so much? Because they do help us with longer term returns. Any given 1 year, they don't tell us much. The scatter plot's all over the place. We have a very low R squared. But if you look at the subsequent 5 years instead of 1 year, you look at 5-year annualized returns, you can see there's a much better correlation here, and high PEs end up portending to lower future annualized returns over the next 5 and 10-year periods. So it doesn't tell us a lot over the short run, but longer run it does. And we're managing portfolios for the long run, not the short run. And that's why we're reducing some of our exposure to large cap domestic stocks. The other thing is that no matter how we look at this thing's going on 127 months. The longest expansion in record. Now it's not the strongest, but if we just look at the math, we should have a recession every about 5 years. So we should have had 2 recessions over this period. We haven't had any. Now, granted, we had 2 really big ones in 2001 and 2008. So maybe that gives us a little bit longer. But once again, we've got to look at both the risks of the upside and the risks of the downside. And we can't get overly optimistic, but we also can't get overly pessimistic. So let's jump into, so that was kind of a recap of where we are. Let's take a look at the U.S. economy, where we currently stand. So the 10-year Treasury, like I said a little while ago, it's at 1.65% plus or minus. I didn't catch it at the end of the market today, but it was right around 1.65% about 3-4 hours ago. Just a year and a half ago, we were at 3.25%. So like I said, 1.5% basically lopped off the 10-year in a year and a half. That's a pretty big move. We had the 10 minus the 2. We had a yield inversion in August for 3 days. That is back holding right around 20 basis points, 19 basis points. We had a slowdown in the summer last year, and the end of the year definitely showed some improvement. And we think a big part of that was due to the uncertainty of the trade wars and the tariffs. Some of that's cleared up now. We've got a couple trade agreements, a phase 1 deal with China. Some of that uncertainty has gone away a little bit, and you can see in the numbers they've already started to improve. Now, one thing that'll come up and that'll probably slow those recoveries down a little bit is the coronavirus. It doesn't appear that the coronavirus is it's a day-by-day thing. Right before we came in here, they announced that there were 69 deaths today versus yesterday there were 70. And so that's one day where we didn't escalate. 2 days doesn't make a trend, but we definitely will be keeping our eye on how that disease progresses. So far, there's been some positive information that's come out over the past week or so that is telling us that we might not have as bad of a issue to deal with here. We'll talk a little bit more about that later on. The jobs market is about as hot as you can get. Last 3 quarters, we averaged 184,000 jobs in October, November, and December. Tomorrow, we get another jobs report. One of the ones that economists and market participants eagerly await. It's one of those numbers that the wage growth number is very important for inflation expectations. Anytime that wage number has gone above 3.5%, the market's gotten a little skittish. If we look at longer history, anytime that number goes above about 4%, it's usually not very good for corporate profits. And so the market is just reacting that whenever that thing goes up above 3.5%. Hey, Jared, can you mute your phone?
For a married couple. What kind of annuity? Immediate annuity. Would you want to see
All right.
most likely joint survivor?
We're let's see here. Oh yeah, so we've got a very strong job market. Hold on, guys.
Okay.
Yeah.
Sorry about that, guys. Somebody's phone was not muted correctly. Okay, so let's get back. So we have a really tight job market. Really interested in the wages. As those wages get closer to 4%, the market doesn't really like that. 2019 GDP was up 2.3%, a little bit lower than in 2018. 2018, we had the significant positive impacts of the tax change, which brought a lot of demand forward, a lot of activity forward. And then 2019, we had the trade wars, which was a detractor. We should be able to see how that all play out here at the beginning of the year. We should get some more clarity on what the 2020 expectations should be. Our take on it is we should be coming right around 2.5 to 2.75% with some of the manufacturing and leading economic indicators turning more positive from last year's trade war. All right, so we talked about the jobs market here. We had a drop in that wages, which was actually applauded by the market. Anytime that goes up above 3.5% is where the market gets a little skittish. But right now, there's really nothing you can say about the job market that's bad. We're at 3.5% unemployment rate. Depending on what annual figures you're looking at, the Atlanta Fed wage tracker is up 3.7%. Average annual wages are up 3%. So it's a very tight job market, and it shows in the numbers, and we'll continue to monitor those numbers. Like I said, we'll get a new jobs report tomorrow. Consumer finances. Average annual earnings are up 3.5%. We've got a decent job market. Housing's still affordable. Gasoline prices are still low. Balance sheets look very impressive. We've got $8 in assets for every dollar in liability, and most of those are mortgages. The consumer really has the ability to go, buy an expensive Corvette, buy an SUV, spend money on just about anything. The savings rates are up. The disposable debt to disposable income ratio is low. So the consumer is going to be able to withstand a lot of pressure. And since the consumer is 70% of the U.S. economy, right now it's very hard to paint on a picture on how the U.S. Will be thrown into a recession. But sentiment could change. You get some ill impacts of the coronavirus slowing things down. You get CEOs worried. It can manifest itself, but right now the consumer looks very strong. Household formations are finally up. This is millennials, finally making it through the Great Recession, and now they're getting married, they're having kids, and they're buying homes. And so this is a very positive trend. You usually don't, at the end of a cycle like this, you usually don't get a boost like this, but we'll take it. It definitely is a positive for the U.S. economy. Federal finances are not in as great of shape as consumers. We actually are projected to have $1 trillion budget deficit for 2020 at a time where we're, deep into this expansion. This is a time where really we should be trying to bring down that budget deficit. So in the short run, it's going to act as a tailwind. But if the CBO forecast is correct and we go from 79% debt to GDP or percent of GDP as debt, and we go to almost 100% in the next 10, 11 years, that's a worrisome number. Now there's already talk about how they can improve the Social Security and Medicare programs by attacking Social Security with the Social Security 2100 Act. That definitely is something that's going to be needed to be discussed and figured out over the next 10 years, because Social Security and Medicare, the trusts are set to run out of money, depending on which one you're looking at, around 2033, 2035. And the Social Security 2100 Act does increase taxes on working aged individuals and actually improves the Social Security and Medicare situation. So it's something that the president brought up in his State of the Union address a couple of nights ago, but it's also something that a lot of politicians bring up and then kick the can down the road. It's going to be very hard to kick the can down the road here over the next, call it 5 to 10 years. So it's something that we think will be addressed here shortly. We kind of talked about GDP. I'm going to skip that one. International, like I said, in the summer, we went through a manufacturing contraction. It's about the third contraction we've had in manufacturing over this expansion. And none of them thus far have caused a global recession. You can see that at the end of the year, we picked up both in manufacturing and services. That was, in our estimation, due to more optimism on the trade deals. We did have the signing of the USMCA in early January. And then we also had the China Phase 1 deal signed. So it just took a lot of that uncertainty out of the market. And what was a headwind in 2019 may end up being a tailwind once some of this coronavirus scare gets through the system. You might start to see some of these positive impacts, especially given the fact that China, I think I'm one slide ahead here, but China started to do monetary stimulus late last year, and that should play through the system as well. Emerging markets, over the long run, we believe that emerging markets will give us a very good rate of return. It's one of the big structural or demographic pieces of information is that there's just a lot of folks who are in some of these emerging markets that are in poverty right now, and that are going to be brought out of poverty. This chart here, and this was actually the chart I was going back to 2009 I know there was a chart somewhere back there, but I went and I was able to find, if I just went back to 2013, China had 18% of their population that was in the middle class. That number is now 34. India had 7% in 2013, and now they have 14%. So if we fast forward to 2030, we're projected to have, close to 1 billion people in these emerging economies that are going to go from poverty to middle class. As that happens, there's going to be a lot of opportunity in those areas, and we think that there's going to be a lot of growth and a lot of potential stock returns in those areas. The other thing that we want to be cognizant of, and this goes back to why we're lightening our exposure to domestic large cap. You can see that over the years, you go through cycles of where international outperforms domestic, and then domestic outperforms international. And it's really, if you look at this, it's somewhere between 3 and 6 years usually. And the outperformance is all over the board, 375% international outperformed in 6 years. Well, in the last 12 years, domestic has outperformed international by 150%. We definitely want to be cognizant of that. And that's why when I look at the entire portfolio and I look at opportunities that we have, if we're looking outside the United States, we're not as expensive as we are inside the United States, especially when you're comparing large cap US to other areas. And this is just another way to look at it. You can look at dividend yield or price to earnings multiples, the 20-year averages versus where we are now. And you can see that international looks a lot more attractive, and it's mainly because they just haven't had the same kind of return that we've had since the Great Recession. Let's talk about central banks and interest rates for a little bit. So we had a huge drop in interest rates over the last year and a half, somewhere along the line of 1.25% to 1.5%. You don't see the real yield at negative very often in history. Recent history, it's happened 3 times. It doesn't happen for very long before we usually go back to positive. And then if you look at the last 60, 70 years, you can see that it's only happened a couple of times in history. And when it does happen, it quickly reverts back to positive yield. So we do believe that interest rates are going to go higher from here, which is going to have a couple of impacts. One, it's going to have an impact on our bond portfolio. 2, it could reduce the multiples that people are willing to pay. So right now we're at, call it a 19 multiple on the S&P. If the 10-year treasury wasn't at 1.65, let's say it was at 2.65, maybe people are only willing to pay 17 times multiple in that situation. So as interest rates rise, if we don't get earnings to rise as well, then we could have some pressure on prices in a market like the S&P 500. So you also want to kind of know where rates are and maybe where they're headed. The Fed, they don't think they're going to cut anymore. According to the Fed, the blue chart is the Fed's dots basically, and they're on hold for 2020. It's basically what they're telling us. The market doesn't believe them. The market thinks they're going to cut another 2, possibly even 3 times, which in our estimation is pretty ridiculous. Right now, we're at a negative yield on the Fed funds rate. There have been Fed governors that have come out and said that they believe a 0% real Fed funds rate is really where they should be targeting. And right now, they're much easier than that. With the tariff wars or with the trade wars kind of behind us a little bit. I know we've got the coronavirus still outstanding, but I don't think the Fed is going to be quick to cut rates another 2 or 3 times like the market thinks. And the longer they don't cut rates, the more the market's going to expect not cutting rates, and the higher the entire yield curve is going to go. Bonds are not a great investment right now. Like I said, the 10-year is at 165. This is the chart of 10-year annualized returns based on a starting rate. So basically what this is telling you is that the rate you earn from your bond most of the time is right around where the starting yield is. And that's why this curve follows the 10-year returns. So if we're looking at 1.65, this blue line, if we were to update this slide, this blue line would be down here below 2%. And we would expect over the next 10 years to earn somewhere right around 1.65% from our bond portfolios, if we're looking at safer portfolios. So that's, over a 10-year period of time. Right now, I can buy the S&P 500, take a lot more risk, but earn a 2% dividend yield, and then have the potential over 10 years for the S&P 500 to go up, let's say 5% per year. And now you add the dividend yield, and now you're at 7%. If you're able to take a little bit more risk, that seems to be a lot better risk return relationship than earning 1.65% over the next 10 years. Now, that doesn't mean that we're abandoning bonds altogether. Every single one of our investors, especially the ones that are getting close to retirement or are in retirement, they need safety in their portfolio. And one of the best places to get that safety and to eliminate some of the uncertainty is by using some of the fixed income markets. And I'll talk about that and show a previous example of that here later in the presentation. This slide, I just absolutely, I love this slide for a lot of different reasons. But this is another one that came from Jim Paulson's presentation, and it shows the risk return frontier of a balanced portfolio during periods that were below 3% and periods that were above 3% on the 10-year treasury. So right now we're at 1.65%, so we're below 3%. So this blue frontier would be if we looked at history as a guide, this blue frontier would kind of tell us what we're expecting from our risk return give and take. So what this is saying is this dot right here is 100% stocks. It's got an expected return of 16%, an expected risk of, call it 17%. If we were to add 10% of the portfolio to bonds, well, then we're at this dot. This is a 90-10 portfolio, 80-20, 70-30, 60-40, 50-50, and so on and so forth. Now, one of the things, it doesn't matter if bonds are yielding above or below 3%. One of the things I take away from this slide, and this is kind of looking at the efficient frontier, is that 100% bond portfolio, whether we're below or above 3%, you can build a portfolio that takes exactly the same amount of risk, but is much, much higher expected return. Or in this case, just a little bit more expected return, but the same exact risk. And so, that's one of the reasons that Ironwood's most conservative portfolio still has 30% aggressive assets in it. It's because these portfolios don't really look very attractive to us on a risk return relationship. We want to make sure that we're getting a better risk return relationship. But the bigger question here on this slide is when we're below 3%, we get paid for taking more risk. When we're above 3%, we don't really get paid very much more for taking more risk. If we're right here and we're expected, let's call it 8%, if we go 100% stocks, we're taking, twice as much risk for only maybe 1.5% more return, versus if we look over here, we're at, call it 7% return. If we take double the risk, maybe we're up here, we're getting a lot more return per level of risk that we're taking. And so, that's something that we just need to know as a backdrop, as a backstop behind us. We are below 3%, and in history, that's been very positive for taking risk. And it makes a lot of sense, because you look at the S&P 500, it's yielding 2%. You look at the 10-year Treasury, it's yielding 1.65% over the next 10 years. What would you rather have? You'd probably rather have the S&P 500 with 2% dividend yield and the potential for upside capital gain growth. I'm going to skip that chart. We've seen that in the past. It just says basically when interest rates are below 5%, an increase in interest rates usually means an increase in stock prices. Okay, so how to navigate? We want to stick to our prudent strategies. Cash, although it has earned a lot more than it has over the past couple of years, these first years and many years that Ironwood has actively gone out and bought money market mutual funds, because they're actually paying us a bit of return now. We've got pretty decent, returns, call it 2%. Last year's 2.2%, but we're still losing to inflation. And an investment that loses to inflation, it's great over the short run. It's lousy over the long run. So it provides safety. It provides money that you can go and spend if you're a retiree and you have 2, 3, 4 years of your living expenses in cash. Great. We know that the cash is going to be there, and it's going to earn a little bit, and it's going to keep up with inflation. But it's not going to give you that growth that you need for a 20 or 30-year retirement. And so in order to do that, we need to go a little bit down the risk spectrum. Even with cash paying us just keeping up with inflation, we have a lot of cash on the sidelines right now. I'd like to take a look at this chart here, and you can see that there's been a spike in cash. There's a lot of cash. If that starts to reverse and people start to become more confident in the markets, you're gonna see what we saw in other periods of time where the markets get, they're not just a little overvalued, they get extremely overvalued. And that's when we start to have concerns about excess risk and other things that happen during those periods of time where people get, become way too aggressive and then are holding the bag when everything pops. So we want to make sure that we're cognizant of that. The other thing that I thought was interesting is, and we showed this we showed this at the end of 2018. We showed a very similar graph here at the end of 2018. My time frame was different, but at the end of 2018, we saw a big spike in folks looking up what a recession is. And you could see in August, so this is after the tariffs, we had a really bad August, a bad May, a decent June and July, but really August we pulled back, and you could see a lot of people, okay, I want to Google what's a recession, and are we in one, and what does it mean? And this tends to tell you that a lot of people are preparing for it, hence this spike in cash. We didn't have a recession, and therefore markets recovered, and you were, if you stuck with your guns and you stuck with a diversified portfolio, you were rewarded with a decent return for 2019. Look at it in a little bit different manner here. We've got the green here, which is all bonds, so inflows into bonds. This teal color is inflows into money markets, and this darker green is inflows, or in this case, outflows from equities. And you can see from the beginning of 2019, January 2019, we've had about 600 billion into bonds and 600 billion into cash. So about 1.2 trillion into bonds and cash. And we've had 100 billion or so that has been taken out of stocks. That should show you that the type of environment that we're in. If Paulson's correct on his super cycle, there's a lot of people who are preparing for this recession and this bear market that it might not come. And the next leg up in this super cycle might be when these people cry uncle, and instead of keeping a whole bunch of money in cash or bonds, they say, you know what, I'm not even keeping up with inflation here. I need to get this money to work. And I see everybody else making 10 and 15% returns. I need to get some of this money back working for me. They put it in, and then we go to new highs, and then that's when the super cycle starts to get a little excessive, and then that's when we'll have another consolidation period according to the super cycle theory. So earnings yield versus bonds, we already talked about this. I'm not going to spend too much time. Stocks are more attractive than bonds, no matter how you look at it, really. Earnings are not projected to fall off of a cliff. You know, we're supposed to be up maybe 4 or 5% this year on earnings. Profit margins did not fall off a cliff. We're still above 10%. This is just, I've had this in every one of my presentations here over the last couple of years. I think it really talks with familiarity bias. Every one of us on the call, I believe, lives in the United States. And therefore, we have a bias to look at the S&P 500, the NASDAQ, the Dow, and less of a propensity to look at the emerging markets, developed international, Europe, Japan, and other areas that are outside the United States. And so this just tries to show you that there are biases, and we have to be aware of them. It shows financials, technology, industrials, and energy. And it shows the somebody who lives in those areas, what their portfolio is overweight because they're familiar with it. Technology, okay, we would guess that the West Coast would have a bias towards technology, and they do, plus 10%. The South and Southeast, we would expect them, they know energy. That's a lot of the industry out there. They have 14% overweight in their portfolio for energy. Midwest, industrials, overweight in industrials. Financials are back east, and we have an overweight in our portfolio in financials. So that just shows the bias inside the United States. But if we take this and we look at outside the United States, we can see that total GDP, 76% of global GDP is outside the United States. 76% of growth is outside the United States. I think that's pretty important. And we don't want to just have 100% of our portfolio that's dealing with 24% of global GDP. And then we look at the investment universe or global stock and bond markets, 64% is outside the United States. And then we look at how most US investors are allocated, 70-30, 71-29, which is still better than I would expect. But we need to make sure that we're aligning our portfolio, especially in a period of time where we believe that domestic stocks may be a little overvalued and international and emerging markets might look a little more attractive. We want to make sure that we're looking 10 years down the line and making sure that we have some exposure to some of these areas. Why should we have commodities in the portfolio? Commodities have a really bad string of returns over the last 5 or so years. They're a good inflation hedge inside the portfolio. They're very volatile. They help us with rebalances. When they do really well over a short period of time and we rebalance the portfolio, we sell some commodities and buy other stuff. When it's exactly opposite, where some of our commodities drop in price very quickly and we do a rebalance, we're able to buy at some opportune times. So it's just a good diversifier inside the portfolio, helps with our rebalances. Do we expect a huge return from commodities over the long run? Not a huge return. Do we expect an asset class that's going to act a lot differently than stocks or bonds? Absolutely. And that's one of the areas, and that's one of the reasons that we have commodities inside the portfolio is one, they're volatile and they can add to our rebalances. They add value to our rebalances. And two, they have a negative or they have a low correlation to stocks and a low correlation to fixed income. And so that really helps us in those times when we have high inflation or low and rising inflation. Commodities are going to give us a decent return in that type of an environment. Now, I know I'm not a huge fan of bonds right now, and we have our portfolio is very light bonds, as much as each of our portfolios will allow. So each of our investors gives us a mandate, and we are on the low side of that mandate across our fixed income portfolios. But you never know what's going to happen tomorrow. And this is just a time frame, late 90s. We started with $100,000. We have an all S&P 500 portfolio and a 60-40 portfolio, 60% S&P 500, 40% Barclays US bond. You take that out, and in 2002, in your all stock portfolio, you lost 30%. You're at $69,000 versus 91,000. You're probably feeling a lot better about your portfolio when you're only down 9%. I mean, you're not feeling great because you're down 9%, but still, you're compared to somebody who's 100% in the S&P 500, you're feeling a lot better. Then we get up to 154,000 and 145,000 before the Great Recession started. And once again, that S&P 500 is now back to 70,000. You're looking at 10 years and you haven't gone anywhere. In fact, you're down 30% over 10 years in this scenario versus your 60-40 portfolio. You're up. You're up $5,000. It's nothing to write home about, but you're feeling a lot better than an all S&P 500 person, that's for sure. And then during this expansion, now that's where you really get the benefit of the S&P 500. And just recently, you start to outperform a 60-40 portfolio, but you took a lot less risk in this 60-40 portfolio. So it's less about are we in this super cycle and is Jim Paulson and seeing right that we have another 10 years and things are going to be good, and we don't know that. Yeah, we can look at history, we can look at things, and we can position portfolios. But the biggest thing we can do to help with uncertainty is add a big chunk of safe assets to our portfolio. They're going to act as a cushion for our more aggressive assets. And you can see over this 20-some year period of time, you didn't give up a lot of upside, but you gave up a lot of the downside. We're going to skip this one here. Okay, so this is another one that with the S&P 500 doing so well, this is something we hear from younger folks more often. Some older folks, but I would say this is more that we hear from clients who are accumulating versus decumulating. But we definitely see it from both sides of the coin. And I just want to show how important it is to have a diversified portfolio. So in 2000, if you went back to 2000, you know, you're right off of the 1999 supermarkets for 3 years, 97, 98, and 99, 30+% returns. Basically, you couldn't lose if you just invested in the S&P 500. You could throw out a dartboard and you'd be able to pick some stocks that were up 100% plus, you know, in any given year during that time. Now, if we start in 2000 and we're in that period and we say, you know what, I'm just going to buy the S&P 500 and call it a day. Warren Buffett tells me I just buy the S&P 500 and call it a day. Well, I'd say you may want to have a little bit more complicated of a portfolio than that because you never know what asset class is going to do the best over any given 10-year period of time. And therefore, we want to make sure that we're able, you know, if our goal is to retire at X, you know, 4% distribution from our portfolio, well, if you retired in 2000, you're not looking very good right now. And here are just two portfolios. I use this balanced portfolio, which is 25% S&P 500, 10% small cap, 15% developed international, 5% emerging markets, 30% Barclays Capital Aggregate, which is bonds, 5% market neutral, and 5% commodities. So I take that balanced portfolio and I say, okay, in 2000 we start with $1 million portfolio, and we have the balanced versus the S&P 500, and we take 4% or $40,000 a year during this period of time. At the end of 10 years, in the balanced portfolio, you have more than you started with. In the S&P 500, you have half of what you started with. If I take this out 20 years, so now we're including some better years for the S&P 500, giving it time to catch back up a little bit. Well, in the diversified portfolio, the balanced portfolio, you now have 1.2 million bucks, and you've been taking $40,000 out a year, versus you have $635,000 if you just bought the S&P. So it really does depend on your portfolio, on your goals, on the cash strain on the portfolio, what you need it for. And that's really what Ironwood helps each of our clients do, is trying to determine what type of balanced portfolio you need for your situation. This was a slide I thought was pertinent to making sure that we're not just focused on the negatives, that it goes to timing. If we think that the next bear market's going to start in 6 months or in a year, well, look, in the 12 months prior to a bear market, you're still up 23% on the S&P 500. 6 months, you're up 15%. 3 months, you're up 8%. And then 3 months after, you're down 7, down 11, down 14. So even if we were able to time this thing exactly right, which is, in my estimation, impossible to do, but even if we were able to time it, did we really avoid? I mean, we avoided on average 14% decline, which we would have received in 6 months. So if we're 3 months or 6 months off, well, then we could really mess ourselves up either on the up direction or the down direction. And so it's not about trying to time the market. It's about, we want to make the returns. We want our aggressive assets to have long enough to make the returns they should make, 5, 6, 7, 8, 9% over time on an annualized basis. And the way we do that is we figure out, okay, what do we need our portfolio? What is our goal? What is our objective? Build a portfolio that no matter what market is in front of us, that we have the necessary cushion in our safe assets to deal with our cash flow needs, our income needs, so that we don't have to make these decisions. Yes, Ironwood is tweaking the portfolio ongoing and trying to put a little bit of the portfolio right now into emerging markets and international and small cap, but we're not making giant bets away from our strategic long-term asset allocation when we know that strategic long-term asset allocation is going to get the job done for our clients. Yes, we're tweaking, but we're not doing so to bring the portfolio into a space where it's going to have a detrimental impact on our clients' objective. And then once again, this is just since 2004. We usually end on this slide here, but if you're a golfer, you want your ball to go right down the fairway, right down the middle. And you can see this asset allocation portfolio or the balanced portfolio. It's never at the top, but it's never at the bottom. It's right down the middle. And if you're pulling money from your portfolio, it is very important to limit downside risk, because you have limited time to make up for it. And you can see by these charts, if you start and it's a bad time to start, you lose too much and you're taking 40,000, 40,000, 40,000. And then when the S&P 500 finally does recover, it's not enough. You don't have enough principal left in your portfolio to get the oomph that the S&P gives you. So where does this put us? Not a lot's changed. Interest rates crept up to a 3.25 in late 2018, but ever since, interest rates have gone down. That's exactly opposite of what we expected. We do expect rates to go back up above 3% over the next year and a half. Therefore, we don't really like long duration fixed income. We don't like large cap domestic equities. We prefer international. We have no REITs and we have no utilities in the portfolio right now. In this rate environment and the flood of assets that have gone to those areas, we just believe that they're too overvalued. We like small caps, we like developed international, we like emerging markets, and we like emerging market debt. Now, all of those areas have underperformed recently, and that's what's made them attractive. And so we slowly move our portfolio into some of these areas as the markets give us, as we hit some of our metrics. So back in June, we rebalanced everybody's portfolio, and the portfolio team had several targets. We are very close to several of those targets right now. One of our catalysts was the China trade deal. Now, we didn't expect them to do a phase 1 and then possibly a phase 2 later. So we've gotten half of a China deal. We got a USMCA deal, and we had some targets based on those trade deals going through. And we thought the markets would improve markedly if those things happened. We've seen that. We're not quite up to where we want to be. After today's market, we're 1 or 2 good days from being close to a new portfolio rebalance, where we're going to tweak some things. We've already got it set. We're just waiting for our targets to be hit. So just you guys will be ahead of the curve here. If you see some trade confirmations coming through, it means we hit our targets and we've rebalanced the portfolio. So with that, I'll open it up to questions. It looks like we've got a couple of questions thus far. All right, it looks like we do not have any questions. Jared, do you have any questions lined up?
Yeah, Sina, I got a couple questions for you.
Okay.
What's one catalyst that may not immediately flip us into a recession, but may cause us to revisit our outlook?
I mean, there are several, and many times you don't know what those are going to be. Any significant drop in interest rates, any significant drop in employment, any increase in commodity prices and or inflation or wage growth could have us revisit targets.
On the flip side of that, what's a catalyst for another strong, large cap domestic equity market similar to we had in 2019?
I mean, there's no, I can't identify any catalyst that would happen, but continued open free trade where some of these larger companies, these global companies that are domiciled, that are those top 5 companies in the S&P 500, if they continue to dominate into more open trading environment, it could portend well. I think another reason that those 5-10 companies are doing so well is that many of the ETFs that are out there are market cap weighted ETFs. And therefore, when you buy a market cap weighted ETF, you're buying 5.4% of Apple. And as Apple becomes more and more of that index, you're buying more and more of that index, or I'm sorry, of Apple when you buy that index. So I think exchange traded funds are adding to some of this concentration that we see as some of these companies get larger and larger.
Does that passive bubble have you worried at all?
It does. It does, and it makes me think that we're going to continue to see what we've seen over the last 50 years or so, where we have cycles where passive investments do better than active, and then you have cycles where active investments do better than passive. So if everyone owns the passive, let's say every single person, all they own is passive investments. Well, if somebody has the ability to come in and value companies correctly, they could do very well as an active investor, because they know everyone's portfolio is the benchmark, is the index, and therefore they could identify companies that are not valued correctly and either short sell them or buy them, depending on if they think it's undervalued or overvalued. And over time, they could do very well if they were the only active manager and they did a good job of identifying values, long-term values of companies.
Got it. Thank you for answering the questions, and thank you for another job well done. Again, we really want to thank you guys for joining us tonight. It's a real pleasure for us to be able to do this for you guys. We will be posting this, the video, online here, hopefully tomorrow, no later than Monday. And thank you again for joining us for the first webinar of 2020.
Thanks, everyone. We'll see you the first Thursday in May, I believe. Take care. Bye.